Hey everyone, and welcome back to the channel. Today, we're diving into a topic that many of you have asked about, especially those interested in growing their wealth right here in Malaysia. We're talking about dividend investing. Now, before we get started, a quick but crucial disclaimer. What I'm sharing today is purely my personal opinion and research. It's not financial advice. Investing involves risks, and your individual circumstances are unique. Always consult with a qualified financial advisor before making any investment decisions. Got it? Great, let's get into it. Dividend investing. The idea of earning regular income from your investments sounds incredibly appealing, doesn't it? Who wouldn't want a steady stream of cash flow from companies sharing their profits? And for a long time, it's been a popular strategy globally. But today, I want to explore why, in my personal opinion, dividend investing in Malaysia, specifically, might not be as suitable or straightforward as some believe. I've got 4 key points I want to unpack with you. My first point revolves around the tax trade-off between dividends and capital gains in Malaysia, especially for high-income earners. For years, dividends from Malaysian companies were entirely tax-exempt for individuals due to the single-tier tax system. However, that has changed. Effective from the year of assessment 2025, a new 2% tax is imposed on an individual's total Malaysian-sourced dividend income that exceeds $100,000 per annum. This means that while most retail investors with smaller portfolios remain unaffected, if your goal is to generate very high passive income that breaches this new threshold, a portion of that income is now subject to tax. Now, compare this to capital gains. Currently, capital gains from the disposal of shares listed on Bursa Malaysia are generally not taxed for individuals. This difference is critical. If your primary goal is long-term wealth accumulation, an investment strategy prioritizing capital appreciation, which is generally tax-free, may be more efficient than one that generates potentially taxable dividend income above the 100,000 limit. This shift, introduced in the Finance Act 2024, strengthens the tax efficiency argument for capital appreciation over high dividends for investors in the higher income brackets. My second consideration is the often limited growth prospects of traditional high dividend-paying companies in Malaysia. Many of the companies known for consistent, high dividend payouts here tend to be in more mature, established sectors like utilities, plantations, or banking. While these companies can be stable, their future growth potential might be slower compared to younger, more aggressive growth-oriented companies that prefer to reinvest their earnings back into the business for expansion rather than distributing them as dividends. If your investment horizon is long, say 10, 20, or even 30 years, prioritizing capital appreciation through growth stocks, especially in emerging sectors within Malaysia, could potentially lead to greater overall wealth accumulation. Research from investment banks and fund managers in Malaysia often highlights the trade-off between dividend yield and capital growth, suggesting that companies with high dividend yields may signal a lack of reinvestment opportunities, as discussed in sector performance reports by firms like Maybank Investment Bank or CIMB Equities Research. Thirdly, we need to talk about the dividend trap and the dangers of yield chasing. It's easy to be enticed by a seemingly high dividend yield, but sometimes a high yield is a red flag, not a green light. A company's dividend yield goes up if its stock price goes down, even if the absolute dividend payment remains the same or even slightly decreases. If a company's business fundamentals are deteriorating, maybe facing competition or high debt, its stock price will fall. A high dividend yield in this scenario might just mean the market is pricing in future dividend cuts or a struggling business. Investors chasing these high yields without thoroughly examining the company's financial health can find themselves in a dividend trap where they collect some income, but their capital erodes significantly, offsetting any dividend gains. This is a common pitfall globally, and Malaysia is no exception. Financial publications and investment education platforms frequently warn against the dividend trap. For instance, articles on the edge markets or iMoney Malaysia have often discussed this phenomenon in the local context, emphasizing the need for fundamental analysis beyond just dividend yield. Finally, my fourth point is about opportunity cost and the availability of alternative investment avenues in Malaysia. By focusing solely on dividend stocks, you might be missing out on other, potentially more lucrative or diversified investment opportunities. Malaysia offers a range of investment products beyond individual dividend stocks. We have a robust unit trust industry, exchange-traded funds, ETFs, real estate investment trusts, REITs, that often have attractive distribution yields, and even alternative platforms like P2P lending. For some investors, a diversified portfolio including growth-oriented equities, bonds, or even alternative assets could offer a better risk-adjusted return profile, especially when accounting for inflation and long-term wealth accumulation goals, rather than strictly sticking to a dividend-centric approach with its inherent limitations. Reports by financial institutions and wealth management firms in Malaysia, such as those from FSM1 or Kenanga Investors, often advocate for a diversified investment approach tailored to individual goals, illustrating the spectrum of investment options available to local investors. So, to summarize, while dividend investing has its merits, I believe that for many Malaysian investors, the tax structure favoring capital gains, especially above the 100K threshold, potentially slower growth from mature dividend payers, the risk of falling into a dividend trap, and the opportunity cost of not exploring other diversified options make it a strategy worth scrutinizing carefully. This isn't to say dividend investing is bad. It absolutely has a place for certain financial goals, like generating passive income in retirement. But for those aiming for aggressive capital growth, or who haven't fully understood these nuances, it might not be the most suitable primary strategy. I'd love to hear your thoughts on this. Do you agree? Disagree? Share your experiences with dividend investing in Malaysia in the comments below. And if you found this video helpful, please give it a thumbs up, share it with a friend, and don't forget to subscribe for more insights into personal finance and investing in Malaysia. Remember, always do your own research, and when in doubt, consult a professional financial advisor. Thanks for watching, and I'll see you in the next video.